Jeffrey Kleintop is the Chief Global Strategist at Charles Schwab, and he's been kind enough to help us kick off our programming this hour. Jeffrey, good to see you. Good morning.
Thanks for having me. Great to be with you.
Okay, buy, sell, or hold. I think at this point, that's just what people want to know.
Sure. Well, I think that, look, if you've got a lot of cash on the sidelines, maybe there's an opportunity here to begin to move some of that in with some dollar cost averaging. But look, we've got some tumultuous markets still ahead of us here over the coming quarters. I think one of the things you can watch, no one knows where the market's going to go here in the near term, but the currency market may remain an important tell for stocks. This morning, S&P futures are up a little bit, but so is the dollar. I'm therefore skeptical of that rally we're seeing in stocks. Stocks completed this round-trip voyage. They're now back at their lows, as you just pointed out. European stocks are now entered into a bear market. But that was after a summer where we saw stocks begin to rally, but the currency market didn't. The dollar continued to rise over the course of the summer, telling us that maybe that rally was going to be short-lived. It's difficult for me to imagine a durable rebound in global equities without the dollar at least stabilizing.
So the currency, I mean, is there any other storyline you're watching that determines whether or not stocks continue to slide or whether or not we see some kind of stabilization?
I think the earnings picture will be very important as we get into this Q3 earnings season. Earnings have been support for stocks so far this year. Generally, results have come in better than expected, both in Q1 and Q2. But now in Q3, we've got companies burdened with excess inventories, a soaring dollar, which can act as a negative for U.S.-based companies as they report their overseas sales. And that could really act as a drag. So we might see finally a break here in the analyst optimism around the earnings picture. Remember, so far, this has been a price to earnings ratio driven drop in the market. Earnings still look to be up maybe mid-single digits next year. If that begins to break down, that could give us another leg to the downside. So I see more risk through this earnings season than what we've seen in each of the last two.
Okay, so we got to watch, obviously, what the central bankers are saying. We got to watch what's happening in all these global jittery stories like the UK. We got to watch the currency. We got to hear what these companies have to say and then make some judgments based on that. Just in terms of the money flows right now, my Bloomberg colleagues were talking about in this latest wave of selling where it's been more common to see pressure. So energy and telcos, and this is the U.S., mind you, have generally underperformed. Staples and healthcare have done relatively well. Then you've got technology, consumer discretionaries, essentially flat. I mean, are there any takeaways sector-wise as you've been watching the sell-off over the last couple of weeks?
Some of the sector behavior is classic in a bear market tied to a recession, right? More defensive parts of the market have held up a little bit better than those that are more economically sensitive, although initially inflation had driven up, of course, energy prices and materials prices. Now they're succumbing to fears of recession, right? So we balanced from a market driven by inflation to one now very focused on recession. I think rather than focus on the one sector that's up this year, energy, all year we've focused on emphasizing quality stocks across sectors, which we've defined in different ways. And one way we've been defining them is high dividend paying stocks. Generally, a sizable dividend is a sign of financial strength and good cash flow. High dividend paying stocks have outperformed during past recessionary bear markets, and they're outperforming this year by a pretty wide margin in the US, in Europe, and Japan as well, even though the overall stock market has suffered double-digit losses. So they might continue to reward investors as company cash flow appears adequate to pay dividends even as the overall economy struggles.
And I guess that feeds back into that earnings story you're going to be watching closely, because that's always the tricky part. Companies might have what, historically looks like a pretty healthy dividend payout ratio, but if times are tough, maybe they move away from it. The flip side is maybe companies are so concerned about this unknown future that they're going to be at the ready to do some shareholder-friendly things. That's the part, Jeffrey, that always I get a little bit challenged on, which is, every CEO out there, they're watching BNN Bloomberg, they're hearing this worry about a deterioration in earnings. I would imagine they are thinking about that as they are preparing for running their business over the next 6 months.
I would think they would want to lower the bar as well. Why not? I mean, there's plenty of excuses not tied to their individual performance. Obviously, from a macroeconomic perspective, central bank perspective, currencies, plenty of reasons why you could lower that bar. However, cash flow still looks adequate, and companies have the most cash flow on their balance sheets, and they've had heading into any bear market recession I look back over the last 30 or 40 years. So I think they're likely to sustain those dividends, which I'm encouraged by. But I think, again, lowering the bar on the earnings guidance could mean some disappointment here as we get into the earnings season as it relates to stock prices.
Okay.